The stone's brilliance meant that a diamond could illuminate the mind and provide clarity. This idea that natural diamonds sourced from the earth carry a power and an energy still holds true today. The first known engagement ring on record is from 1477, when famous European royal Archduke Maximilian of Austria proposed to Mary of Burgundy with a natural diamond set on a gold band. Lapidaries at the time did not have the tools or technical skills to cut a diamond the way we do today, so it was mounted in its natural octahedral form. After that, the tradition of giving engagement rings prior to marriage began to spread around the world, and diamonds began to take on a stronger identity, evolving into the ultimate symbol of love, connection, celebration, and permanence. Today, however, our industry is facing some significant headwinds across the supply chain, and it is my strong view that we are at an important crossroads that is going to determine whether or not natural diamonds can and will continue to hold that coveted spot. So beginning with diamond supply, as most of you in this audience will be well aware, natural diamonds are incredibly rare. There are currently fewer than 30 active mines in the world, including alluvial operations, and their total production output in 2023 was estimated at just under 112 million carats for a rough diamond value of $12.7 billion US. Importantly, 95% of those diamonds by value will be manufactured for use in diamond jewelry, which in 2022 resulted in diamond jewelry sales of over $86 billion. The top four countries in terms of both volume and value are Russia, Botswana, Canada, and Angola, and together they accounted for almost 80% of global diamond production by value in 2023. After being oversupplied for much of the 2010s, depleting legacy mines and a very limited number of new supply sources resulted in significant natural diamond production declines towards the end of the decade, which was punctuated by the onset of the COVID pandemic. For the remainder of the current decade, production is expected to remain within the range of 105 to 112 million carats, which compares to as much as 150 million carats back in 2017. In addition to the existing legislated sanctions on Russian diamonds, many large luxury brands like Louis Vuitton, Tiffany, and Cartier have self-sanctioned, and leaders from G7 nations are currently coordinating on a framework to further restrict the flow of Russian diamonds from entering the larger Western consumer market. Major mines, including Diavik, Ekati, and several in Russia, are expected to either reach economic depletion or conclude conventional mining by the end of this decade. These mines currently account for a combined 17 to 20 million carats of annual production, representing approximately 15% of global supply. In 2019, De Beers said it would move forward with Cut 9 expansion project at the company's Zhuangning mine. In addition, a Cut 3 expansion at Arapa is still a question. Both of these investments will cost multi-billion dollars that will extend the life of the company's two most valuable assets through the 2030s. If underground expansion happens at Zhuangning, the mine life would be extended out into the 2050s. The only major new diamond project outside of these expansions is the Luwele project, formerly known as Luwashi, kimberlite in Northeast Angola. Trial mining commenced there in late 23, and these forecasts assume production wrapping up to about 4 million carats per annum from 2026 onwards. So one would assume that with depleting natural diamond supply all around the world and no large new discoveries in more than a decade, grassroots diamond exploration activity would be elevated and actually ramping up. Remarkably, the opposite is true. Other than Angola, where De Beers and Rio Tinto are investing heavily, global grassroots diamond exploration has pretty much come to a halt. And on this slide, I'm showing, mere pockets of activity representing, a few of the survivors and stalwart explorers. But if we exclude Rio Tinto and De Beers expenditures in Angola, the total exploration investment combined from these other players on grassroots exploration outside of Angola is estimated to be less than $3 million in 2023 and far less than that in 2024 so far. The explorers in this room would be quick to point out that it is not a lack of geological prospectivity that is driving this really concerning trend. So, what is actually happening? How can we actually explain this disconnect? Part of the answer requires a closer examination of what is happening on the demand side of the equation. In the next section, we're going to have a quick look at overall market trends for rough and polished diamonds and the important role of the midstream or manufacturing segment. Following a slow recovery from the global financial crisis, rough diamond prices began a steady decline for small diamonds beginning in 2016 and for larger diamond size classes beginning in 2018. Rebalancing of the supply pipeline in late 2019 led to price recovery in all sizes. However, this recovery was then interrupted by the pandemic. Multi-year record highs were then observed in 2021, which began to retract in 2022 as a result of geopolitical uncertainty and concerns around inflation. As of late 2024, rough prices have drawn down some 30% from their all-time highs, but are finally showing some signs of recovery. And this chart has actually been provided to us by Paul Zaminsky, as is a number of the charts that I'm going to be showing here going forward. And although prices definitely remain above 2019 lows, it really doesn't take away from the fact that when you look at this performance over time, diamond prices have remained volatile for more than 16 years. This is in part explained by the performance of the midstream or the manufacturing segment of the supply chain, where the management, or in some cases mismanagement, of polished inventories can have a dramatic impact on diamond prices. The midstream relies heavily on credit, purchasing rough diamonds and selling polished. Even small market adjustments that can occur in a 6 to 12-week manufacturing cycle can have a material effect on margins and will sometimes lead to the liquidation of polished inventories at heavy discounts, contributing to further pricing volatility. Total manufacturing and trading inventories fell from about 40 billion in 2018 to what the industry considered much healthier levels of around 30 billion by October of 2019. And this was really in a response to a reduction in available credit, a new currency regime and tax policy in India, and a consolidation of smaller, less sophisticated players. Again, following the onset of the pandemic, Indian diamond manufacturing and trade organizations actually called for a voluntary import ban on rough diamonds in an effort to sustain manageable levels. This definitely helped to support the rough diamond price rebound that we did observe post-pandemic in 2021. But once again, we have been building potentially unsustainable inventory levels in response to recent demand weakness. If we move on to look at polished price performance, it is interesting to note on this slide from WWW that prices for polished have been much more stable than rough prices over the last 5 years. Global diamond jewelry demand did also take a material hit in 2020, but aggressively rebounded to record high levels in 2021 and 2022, beginning in lockdown and then aided by record economic stimulus. And I think a real desire during the pandemic to gift more meaningful gifts, especially as consumer spending on experiential items such as travel and entertainment were unavailable. In 2023, aggressive supply chain restocking overlapped and a much softer post-pandemic period impacted by a series of macroeconomic factors that we've already discussed, plus a continued competition from LDGs. I'm not going to spend a lot of time talking about lab grown, but this may come up in questions. But I do want to say that although lab grown are continuing to grow market share, and they are definitely here to stay, what we're seeing is that continuous improvements in technology mean that lab grown diamonds are getting cheaper and cheaper, which helps to further differentiate this market from the market for natural diamonds. Lab grown diamonds will continue to grow and carve out a niche as lower priced fast fashion jewelry. But I really believe when it comes to commemorative gifting, current industry consensus is that natural diamonds should be able to sustain a significant price premium. In terms of market demand by geography, the US continues to dominate with over 50% of market share. But looking ahead into 2024 and beyond, diamond demand driven by an Asian wealth dynamic primarily, as well as continued strong demand out of the U.S., is expected to significantly outstrip future mine supply at a compound annual growth rate of approximately 3%. Global population growth, the pace of middle-class wealth creation, marriage rates, and the effectiveness of industry marketing are other examples of variables likely to impact growth rates going forward. But there is a clear consensus that demand for diamond jewelry is not going away and is expected to strengthen, particularly as younger generations like Generation Z come into their prime spending years. So up until now, we've been focused on showing you supply and demand trends for natural diamonds themselves. This last slide I want to show you in this section examines the historical performance of diamond jewelry against the performance of other luxury goods and GDP. Once again, we are not seeing a very healthy picture. It is true that as an industry, we grossly underinvest in marketing compared to other luxury businesses, which is definitely a contributing factor, but that is not the only reason we've seen jewelry underperforming other luxury goods. And as I've said twice now, I believe that our industry is actually facing an important crossroads. For generations, the diamond industry has relied on the same processes to distribute rough diamonds between producers and the midstream manufacturers. Whilst De Beers retained a more dominant market share of global diamond production, processes such as site week and rough assortment tenders have historically enabled an efficient and reliable transaction paradigm that led to years of healthy profits for all of the stakeholders. That includes the producers, the midstream, and the downstream retailers. These same processes no longer work today, however. Margins have contracted significantly, and the industry has been through several volatile boom and bust cycles, which are preventing the industry from meaningful growth. The equity and debt markets now view our industry as high risk, and these market forces are impairing the financial health of even some of the industry's most successful mining companies. This has had further knock-on effects for investment in brownfields and greenfields diamond exploration projects. So why is this actually happening? Today, each participant in the supply chain, whether you are an upstream mining company, a midstream manufacturer, or a downstream jewelry retailer, you make your margin on the backs of one of the other participants in this supply chain. The supply chain is competitive and opaque and does not instill consumer confidence in the product. As an example, if a consumer goes into the Diamond District in New York to buy a diamond, the first thing they ask is, what kind of deal can I get? If I go to the shop next door, I think I can get 10% less. And so the haggling and the negotiation begins. And I think what we have to understand that this is not a normal way to buy a luxury product. No one would expect to walk into a large luxury house like Louis Vuitton or Gucci and negotiate on the price of a handbag or a scarf. None of these luxury products ever go on sale. We are not selling a commodity like copper or gold or food. We're selling a luxury product. And creating alignment across the value chain is the only way to stabilize prices and promote growth and longer-term price appreciation. The way we currently sell diamonds is also extremely inefficient. Diamonds are an incredibly heterogeneous product. No two stones are alike, and they sell at literally thousands of different price points. As producers, we strive for predictable revenues at regular intervals, and the way we solve for this great heterogeneity is by building up large inventories of our mined diamonds over a period of time, and then we assort them into broad categories based on size, color, and quality. Our customers, whether they are buying through sites or tenders, are then required to purchase an entire assortment or bucket of diamonds, with the only benefit of examining this assortment or bucket. And I don't know if you can see my cursor, but I'm kind of circling where we are here in this in the value chain. They're buying that bucket with really no benefit other than a hand lens. For many producers, this is where their involvement stops. They sell their rough and they have no further insight on what happens to those diamonds thereafter. Did they get the right price? Maybe, maybe not. For the customers or buyers, the first thing they ask when they find out they want a parcel is uh-oh, how much did I overpay? Did I actually crush the competition? Have I eroded all my margin? They then take those diamonds back to their polishing factories, and the first thing they do is they apply scanning and planning technology to find out what they actually believe those rough diamonds will yield when they make a polished stone. And that's when they have their first insight on what those diamonds are actually worth. Even if they didn't overpay, invariably, after doing all that scanning and planning, they find out that a whole bunch of those diamonds are unsuitable for making into the kinds of polished products that they actually sell to their customers. They then have to retrade all of the diamonds that they don't wish. It is estimated that a single rough diamond might trade hands as many as 10 times before it actually lands on the right polishing wheel. This is an antiquated and highly inefficient 100-year-old push-style sales system, which is unoptimized and results in value loss across the value chain. Today, we have no excuse. We have the technology to change this. We can transform the supply chain into a modernized, demand-driven marketplace simply by moving the scanning and planning technology right up to the mine site, where we can take out the mystery and risk of selling buckets of diamonds and can instead start selling individual diamonds based on specific polish demand from the brands driving the correct manufacturing mandate. For the first time, there is the potential for full transparency, linking the price paid for the rough to the actual price achieved for the polished, and individual diamonds can be properly tracked. Pie is then shared in an equitable way that supports responsible businesses that have a sustainable, longer-term strategic outlook. So listen, what we're talking about is transforming our industry from a push-style sales system to a pull-style sales system, from suboptimal to optimal. And by the way, this is not just a novel idea. Over the past 5 years, Lucara worked to modernize its sales strategy in exactly this way. In 2018, Lucara acquired and then began commercializing a proprietary, first-of-its-kind digital marketplace for the transaction of rough diamonds. In this case, high-quality natural diamonds between 1 and 15 carats in size are scanned right at the mine site, and those scans are uploaded to create a web-based digital rough diamond inventory. Our customers, which include the large integrated jewelry houses, together with over 80 manufacturers globally, place digital orders on Clara for polished diamonds. They provide us with a digital blueprint for each polished diamond they wish to manufacture, and Clara uses proprietary matching techniques to assign individual rough diamonds against the polished order that is best suited to maximize its value. COVID became the tipping point that encouraged Lucara to take the next step in this direction. Large diamonds were discounted by as much as 50% during the pandemic, and yet discounts for polished diamonds were much less. We decided to create an alliance with a single diamond manufacturer where instead of selling rough, we would manufacture all of our diamonds greater than 10.8 carats and sell polished. Our polishing partner was guaranteed run-of-mine production for a year, and they were paid based on the final achieved polish sale. There was no risk they would overpay, and we were provided complete access to all of the data, ensuring that we were getting fair value for each diamond sold. John's going to touch on some of the other significant benefits to selling this way a little later. But finally, all of those diamonds that didn't qualify for sale through Clara or through direct manufacturing, and these, by the way, are significant in terms of volume, but less so in terms of value, those were then sold through traditional diamond tenders. And just before I wrap up, I'd like to talk a little bit about traceability, because I do believe this is increasingly important for the future success of our business. Brands are definitely demanding this today, but even smaller jewelry shops in the US are also looking and recognizing the importance of traceability. And it's really important to build and sustain consumer confidence in the product. Consumers want to know that their diamonds come where they come from, and that they're supporting responsible businesses that actually care about the environment and their social commitments, and companies that ultimately are well governed. And on this slide, it's just showing all of the different platforms that have been developed in response to the need for traceability. And what you're looking at here is, I think this will naturally consolidate. And my little plug here for Clara, which I am a founder and director of, is really pointing out that it really is the only platform that is able to offer a comprehensive traceability solution that integrates seamlessly into the supply chain. And it's using technology right at the mindset to track a diamond right through its entire journey through to polished. So to reiterate, and in conclusion, I believe there's no question that we are at an important inflection point in this business. If natural diamonds and diamond jewelry are going to prevail as the ultimate symbol of love, connection, celebration, and permanence, our industry must have the foresight and the ingenuity to challenge the antiquated processes that lay at our foundation, and use recent advancements in technology to reinvent our supply chain. Natural diamonds are not a commodity, and we've got to stop selling them as one. So thank you very much. I'm going to stop sharing and turn it over to John for the next section.
Thank you, Eira. It is a very thorough synthesis of the diamond market and great suggestion for a supply chain. So coming up, our second speaker, John Armstrong, has over 30 years of experience in mineral exploration, mining, and government. John was a district geologist for diamonds with Indian and Northern Affairs in Yellowknife from 1998 to 2004. Then, with Stornoway Diamonds, John was involved with various exploration projects in the Eastern Arctic and worked on the grade, size distribution, and value models for the renowned kimberlites. From 2013 until earlier this year, John, with Lucara Diamond Corporation, was involved in the implementation of innovative diamond recovery techniques at the Karowe Diamond Mine. Notably, he was instrumental in the establishment of the XRT recovery circuits. With his experience in the assessment and analysis of diamond size and value distributions and diamond content modeling, he was involved in the modeling of the unique diamond size distribution of the Karowe kimberlite. Other roles at Karowe related to technical aspects include diamond exploration and sampling programs ranging from generative to delineation and valuation. He also led the Lucara team through study phases and ultimately to start the underground mining in progressing the Karowe underground expansion project. John, the stage is yours.
Okay, thank you, Gary, and thank you to the Vancouver Kimberlite Cluster for the invitation to give this talk. That, as Ira mentioned, we gave these talks as keynotes at the International Kimberlite Conference So good afternoon and good evening to everybody. I will now share my screen and we will proceed from there.
Yep.
Okay, and then I'm gonna also, maybe I'll leave the video on, it's fine. Okay. Oops. Good afternoon, everyone. The purpose of this talk here is a little bit of a rejig from what was presented in Yellowknife, but nonetheless, we're going to talk about diamond exploration and some mining components, worldwide trends, and touch on ESG dynamics. This portion of the business is becoming increasingly important to companies who would like to go out and raise funds for grassroots exploration, for study phases, or ultimately development. It is also a component in our everyday life. Those of us with investments in various companies, the ESG dynamic becomes very critical as to who and where we're going to spend our money, who we're going to invest in. And this runs the gamut from, like I said, your retirement policies and things like that, all the way through to how the research institution that you may be working at or maybe a student at, how they seek out donations and fund themselves and how they're ranked on their ESG aspects. And we're going to touch on some new legislation that has been enacted through the summer, both in Canada and in the EU. So we'll talk a little bit about the current environment, application of new technologies in both exploration and mining, touch on how some of these new technologies, innovations have been used in very mature brownfield environments, mine life extension issues that exist around the world, as we can see from Eira's talk that the supply component of rough diamonds is actually at 112 million carats, off significantly from about 10 years ago. And we know that various mines are coming to their end of life. So to maintain even 112 million carats of production a year is going to be a challenge. Access to capital for explorers, access to capital for developers and maintaining and running mines. And then, of course, the ESG component. On the right-hand side of the screen here is an image of a diamond. It's all diamond. The north-south field of view in this particular image is 6.6 centimeters. So someone can rapidly do the math, and those of you who've heard the talk know the answer, but we'll see the actual weight of that diamond later on, and it was recovered at Lucara's Karowe mine in March of 2023, and we'll talk about value preservation as part of the talk. Right now, following on what Eira said, there's a decreasing expenditure in exploration. We heard last week from De Beers at the Focus 2024 meeting in Antwerp that De Beers will spend exploration dollars in Angola and Botswana and no other jurisdictions. So we have a lack and decreasing of exploration dollars. There's a lack of investor interest, and we're in a persistent price downturn in the rough diamond market, which is causing considerable pressure on producers of all sizes. As noted, increasing presence in certain jurisdictions that have been out of favor for a while, and in particular Angola, with Rio Tinto and De Beers spending big exploration dollars on recent discoveries and on greenfields efforts in Angola. And many high value and high volume diamond mines are late in their operational life and will require capital injections. And in some cases, such as the Diavik mine, will come to its end of life within the next 18 months or so. Significant capital is required for mine life extension at operations like Zhuaning, Arapa, Karowe, Ekati, Gahcho-Kué. But in hearing from De Beers again, the Gahcho-Kué underground efforts have been put on hold, and the spending there has come to an end for the study phase. Access to capital for mine construction, like big projects like Fort Alicorn, and just for exploration, these are all under stress in terms of getting that access to capital. There's been a lack of significant discoveries in the last 15 years, and we all know with protracted timelines from discovery to production can measure in some cases in decades as opposed to years. And some projects are being stranded due to the intersecting issues of corporate priorities, location, logistics, and again, lack of capital. So kind of a, it's not the cheeriest slide, but we know the money is being spent in some significant areas with high potential. Now we're going to shift quickly into looking at some of the exploration techniques. And I'm not going to talk about all of them. I'm just going to touch on a few and the application of drones to carry out surveys of all types. And I'm going to use Sunbird, which is a private entity that has done fixed wing drone surveys in Botswana and northern Canada. These are high quality magnetic data in a stable platform, rapid data acquisition. You can acquire up to 1,000 line kilometers of data per day. It's relatively inexpensive. The footprint is small. The logistics are pretty straightforward, and it has resulted in discoveries in some very mature and data-dense settings, such as around the Ekati mine. There's been a number of kimberlites that were drilled from magnetic data generated through the Sunbird platform. It's been used in Botswana, and in Botswana, targets have been drilled, no success as of yet. And again, access to capital to drill some of those targets becomes an issue. The use of deep machine learning on geophysical data sets. Again, we're going to look at to Ekati in the Northwest Territories, where after intensive machine learning was done on existing data sets, some geophysical targets were identified and drilled, and kimberlites were discovered within 6 kilometers of the Sable Pipe. I'm referring to the Bear and Badger kimberlites up here. And I think it goes without saying that the Ekati claim block has probably had every exploration technique known on the planet thrown at it. It's a very data dense, very mature environment. And using 2 innovative approaches, new kimberlite discoveries have been made in the last number of years. So it points to the success that these techniques will have elsewhere in both brownfields and greenfields opportunities. So the deep machine learning on geophysical data sets, I'm certainly no expert on this, but as mentioned, it was used at Ekati, resulting in some discoveries of 2 kimberlites that have similar characteristics to kimberlites that are being mined on the Ekati mine block or have been mined in the past. In Botswana, this exercise has been done and is being done on public data sets, training unknown kimberlite signatures and generating viable drill targets. So the image to the right shows some geophysical survey with some known kimberlites, and after running the machine learning, there's been generation of a few untested targets that at some point will be done. And again, this was done on public data sets. There is a bit of an advantage, I think, in my opinion, to large companies with large in-house data sets that can be mined and run through the machine learning exercise. There's advantages for others in jurisdictions like Canada, Botswana, and Greenland, where historic exploration data is required to be, the exploration data is required to be sent into the government in terms of maintaining your claim status. People can go in, people can compile that data, and they can use it. Some of the caveats in all this, of course, is you need to know the source of the data. An evaluation of the quality of the data set is required. And the development of teaching guides is also a requirement. And there's a series of human interventions along the way that are required in terms of producing, I think, a usable output at the end of the day. We also have large geochemical data sets that are available, in particular in Canada's north, where we have indicator mineral chemistry, we have diamond indicator mineral chemistry, kimberlite indicator mineral sample locations, xenolith data. I mean, there's lots of data sets out there that can be that if the smart people can start thinking about in terms of the machine learning and generating some new targets. Now I'll shift into some applications of technology and the innovative adaptation of this and adoption of it. Shown here on the screen are some conceptual drawings of underwater remote mining systems that Burgundy Diamond Mines was considering. Consists of a floating platform, a crawler, a land-based dewatering plant. It was to be trialed at the flooded Lynx pit. It's in the latest information out of Burgundy, it seems that they have decided to park this for the moment as they pursue near-term exploration opportunities underground at Misery Pit. But one can see the advantage here, resource life extension, small footprint operations. And, I think that this type of thinking will be carried forward in the future. This type of technology could be exported and used in all sorts of jurisdictions where you want a small footprint. The kimberlite is amenable to this mining technique, and certainly the capital expense should be less than that required for building a whole process plant or the required waste stripping for open pit mining. Now I'm going to touch on something that I've spent quite a bit of time thinking about over the last few years. This is a sensor-based sorting. It's not a new concept by any stretch of the imagination. It's well established in recycling, in food services, pharmaceuticals. I think it's fair to say it's been relatively slow to be adopted by the mining and processing industry. This is, across all commodities. I'm going to spend a little bit of time here talking about X-ray transmission for diamond recovery. It can be done on concentrate or it can be done on size run-of-mine material. It's becoming more common to see these in diamond processing plants around the world, both on concentrate and on just size run-of-mine material. We're seeing it show up in bulk sample plants, and efforts by the OEMs or the engineering and manufacturing firms of these sorters to get the size range to cover all size ranges, including down into the finer diamonds. There's advantages with lower power usage, less water usage. So these machines are quite small. They can be containerized and they can be moved around. Color sorting was used at Renard to kind of get rid of some of the waste material, so that what you're sending to the process plant is dominated by kimberlite and you have less dilution there. It's also in use at Maya in Sierra Leone for some trial mining on some narrow kimberlite dikes there. Again, it's to reduce the amount of non-kimberlite material that's going for processing, and has likely a positive impact for diamond damage. So we're going to talk about the Lucara's Crowe mine in Botswana. In 2015, a series of XRT machines were commissioned. Then another circuit was commissioned in October of 2017. All diamonds at Crowe now in excess of 4 millimeters in size are recovered from XRT sorters on screened run-of-mine material. The capacities in the XRTs range from 45 to 150 tons per hour. And you can see that there's basically 5 circuits here: a submittals, the middles, of course, the LDR, the large diamond recovery circuit, and then the MDR, or the mega diamond recovery circuit, which sits between the primary crusher and the mill. So this was put in stages. Basically, the middles, the coarse, and the LDR were the first machines that were put into play in 2015. And then in 2017, the 4 to 8 and the LDR, or the MDR, pardon me, circuit was commissioned. And there's also 3 XRTs that are used to do live audits on the tails. I think Crowe is probably one of the only mines that does live auditing of their tails. So Lucara basically back in 2014 made the decision to go with XRT, and of course the intervening time to 2015 was the construction of the phase 2 upgrades to the plant. So they rolled the dice and Lucara went all in. And the success was seen about 9 years ago in the mid-November of 2015 with the recovery of the Lassetti Lerona, which is the 1109 carat stone here in the palm of my hand, the 813 carat Constellation. There's a 374 carat stone and a few others. So that was, the immediate payback. There's about in excess of 120 million US dollars sitting in the hand there. We learned a lot through that exercise, or the car learned a lot. It became evident that the 374 and the 1109 carat diamond were once together. Where they were damaged in the plant or in the circuit was a bit unknown. And that, really motivated Lucara to put in the MDR circuit, which captures any liberated diamond after the primary crusher before the mill. This also solved a metallurgical issue that exists at the Crowe mine in terms of the south lobe of the AK6 kimberlite is very fresh. It's got an average specific gravity of around 3.0. So you end up with a massive DMS concentrate. So the XRT is basically agnostic to that and is looking for the mean atomic number of the material in the belt. And we know the mean atomic number of diamond is that of carbon. So it's a pretty, relatively straightforward sorting algorithm. 90% of the revenue at Crowe comes from the XRT circuits. And they've been placed in such a manner really to maximize value preservation. So shown here are three diamonds that look incredibly different, all come from the same deposit. There's the 1174 carat stone here, recovered in 2021. The 549 carat Sethunya recovered in 2020, just before the pandemic shut the world down. And then this 862 carat stone, which you remember from the first slide, was recovered in March of 2023. Each of these diamonds represents significant revenue for Lucara, and each of them tells you there's a very diverse, large diamond population at Crowe. That MDR circuit that I touched on to the end of the first quarter of this year had recovered only 8 diamonds, representing about $40 million US, ranging from 278 carats in size to 1174. Events have changed since then, and the MDR is now responsible for the recovery of the 2,488 carat stone in August of this year. So here, when I gave this talk at the Kimberlite conference, this was more about talking about the 1,758 carat diamond, which was the Suelo, was 83 millimeters in its long dimension. It's an intact stone, no breakage on it. And in August of 2023, 1,080 carat stone and a 111 carat stone were recovered in the same day. They were part of the same stone. You end up with 87 millimeters in the long dimension of that. And this was just to remind everybody that the Cullinan was about 1,000 millimeters long, based on the information that we can see now. The Cullinan being the 3,100 carat diamond from 1905, I think, was when it was recovered. And then, like I said, events have changed. August of 2024, Lucara announced the recovery of this as 2,492 in the press release after cleaning 2,488 carats, followed by a 1,094 carat gem. So now, since 2015, Crowe has produced 6,000+ carat diamonds. There's an image of the 2488 from Lucara's corporate presentation of the third quarter of this year. A massive looking stone. They didn't give us the dimensional data in the press release, which is unfortunate, but I think it's pushing into that 1,000 millimeter in length range. So, does Crowe have the opportunity to surpass the Cullinan diamond? I would say that likelihood exists. The size distribution is extremely coarse. You need to have everything align in terms of recovery of these large stones. It's not an easy process to do that, and I think with the XRT and the adoption of XRT was the correct move at Crowe. The other component that I'm going to talk about here relatively quickly, I could spend a lot of time speaking to these two images on the right portion of the screen, but now we've gone from exploration through to mining, processing, and now we're going to look at diamond manufacturing. There's been some incredible advances in the last 15 years around the mapping and the planning of rough diamonds of all sizes, but in particular larger diamonds. And as part of that has been kickstarted, obviously, by the recoveries from Crowe and some of the recoveries from Letseng in Lesotho, but more dominantly from Crowe. With this advances in mapping and that, you end up with higher polished yields. There's less risk on the polished outcome from the plan to the actual. There's improvement in yield and in clarity, which drives up the value of the ultimate polished product that is sold, because you have more polished diamond to sell, and it's of a better clarity. As part of the arrangement that Lucara made with HB Antwerp, that was alluded to in Eira's talk, What it allowed Lucara to see is incredible insight into the rough production as it transformed into polished, to better understand components of the production that is usually lost to the producer because the story kind of ends when the diamond is sold at tender or however it's sold, and the feedback loop isn't always there. What was learned about the Crowe production was that the predominant color of the polished, whether it be by weight or by count of polished stones, was dominated by first color stones, so DEF stones. And if you looked at it in just terms of first color D, about 46% by weight and almost 48% by count of all the polish that comes off the Crowe stones in excess of 10.8 carats rough is first color D color, which is a significant learning for the producer. So if you were selling these diamonds through another mechanism and you're getting pushback on the color profile of your goods at Crowe, you can now say, look, it's 50%, over 50% of them are going to be D, so you need to, pay appropriately. The bottom image here is there's a lot to unpack here. What we're showing on the X scale is the polish yield, so the amount of polish, the percentage of polish that come out of the rough. The y-axis is the polished diamond value sold, ranging from basically zero all the way up to 16 million US dollars. And then the symbols represent rough diamonds in the range from 100 to 150, 150 to 200, and so on to in excess of 300 carats. That would be the rough weight. And now we're taking the cumulative value of the polish that have come out of those stones. There's a couple of takeaways here, and this is all about this component about mapping, planning. There are some very large diamonds here that produced very low polished yields. So we're looking at mid-teens in terms of the polished yield that came out of the stone, but the values ranging from 3 to like 5 million all the way up to 15 million US dollars. I can tell you that if these stones were sold through a traditional tender mechanism, Lucara would not have achieved those values. So the bulk of that value for the polish sold went back to Lucara. These stones here all would have sold for sub $1 million at tender. This particular diamond up here, which is the 1174, would have sold for probably in the range of maybe 6, maybe something less. The other advantages to this increase in the ability to manufacture stones sits out here. We're looking at polish yields in excess of 50% on diamonds in the size of in excess of 250 carats rough, a couple of 200 carats here. So this means that the polished outcome out of these stones, you're getting over 100 carats of polished out of these particular rough diamonds and generating value between 8 and almost 10 million US dollars. So these advances are critical for the large stone market, I believe, but the benefits extend all the way down into the bottom end of the rough sizes in terms of mapping and planning and getting the maximum yield and the maximum clarity or what you choose to polish out of the goods. Now we're going to talk about ESG and access to capital. Having a strong ESG performance is key to accessing capital for explorers and mine builders. And we've talked about this previously in the talks now. These high volume and high value diamond mines are late in their operational life. Significant capital is required. If we look at Zwaneng and Crowe alone in Botswana, those two, the work that's being done there underground represents about 1.6 US billion dollars of expenditure. It's roughly split right now about $1 billion US dollars for Zwaneng for an underground test mine, and about $600 million being spent at Crowe to sink 2 shafts to access the south lobe of the AK6 kimberlite. And these expenditures exclude costs related to the PEAs, the feasibility studies, the drill programs associated with that prior to making the decision. These are significant investments into a very small population base in a workforce setting, so it does create pressures on all parties involved. And the other comment here would be, single asset companies are under pressure in the current market. We can see this with Lucara, you can see it with Mountain Province, you can see it with Lukapa, and others is that people struggle to get access to capital. This information is from the Responsible Mining Academy, talking to C-suites and CEOs of mining companies to identify what they feel the top mining risks are. And you can see across the top over the last 3 years, it sits in this ESG bucket. The other ones, we don't have a lot of time to go through them, but they kind of move around, but there's a lot of similarity. But number one, the last couple of years has been ESG. Basically, ESG covers environmental, social, and governance buckets. It's really a framework for investors to use to assess the risk that sustainability issues may pose to their investment and to company performance. And this, we're talking about, mining at in this talk, but this can be across all commodities. It can be through textiles, it can be through jewelry, it can be through many, many things. In terms of how companies are performing. There is discussion. It's been ESG for a period of time, but they're more and more, the focus is on, the first step being good governance. So the concept of ESG, I don't think is going to change. How people phrase it or word it, or we may see more and more emphasis on governance, because good governance drives the good social and the good environmental performance. So in terms of top ESG risks, we have several that have been identified: community impact, tailings, decarbonization and climate change, biodiversity, water management, and diversity. So I'm not going to go through all of these, and this list here I've put beside the local community impact is by no means the full and complete list. But, top of the list for explorers and those people going into areas for the first time is free, prior, and informed consent, known as FPIC. There's participation agreements, stakeholder engagement, adhering to the Modern Slavery Act, IFC performance standards, the UN Global Compact, so Sustainable Development Goals. All these things are just skimming across the top of what companies need to do with respect to local communities and all stakeholders. Tailings, the mining industry has seen over the last number of years some really horrific failures of tailings facilities, resulting in fatalities of workers, community members, destruction of property. We're seeing that play out in courtrooms in Brazil and in the UK, and with significant punitive measures being taken against the companies. We'll touch on GISTM, which is the global industry standard for tailings management, which has, you're going to see a little bit of similarity to what we've been talking about. 6 key topics are covered: communities, integrated knowledge base, design, construction, operating and monitoring of the facilities, management and governance, emergency response, recovery, public disclosure, and access to information. This is all from the ICMM. But towards sustainable mining from the Mining Association Canada follows along with these regulations as well. Most companies, you can go to their websites and you can understand how they're treating tailings management in terms of the public disclosure. This is very forward looking information. And if you're going to go raise money to build a mine somewhere on the planet today, it doesn't matter the commodity, GISTM will be a requirement, I think, of your tailings management from any lender who's going to give you money. Will want to see how you're going to touch on those aspects. Decarbonization and climate change. So this power usage, CO2, greenhouse gas emissions, this cuts across all industries, and at the moment, great research has been done at places like UBC around CO2 sequestration using kimberlite tailings or ultramafic tailings to put CO2 into to get it out of the atmosphere. Biodiversity, water management, diversity in terms of gender, pay equity, equal opportunity. These are all components that will be scrutinized by any lender who you've sought money from. And these same criteria will be looked at from an investor's component if they're going to invest in your company and track your performance. Part of this is done through something known as sustainability-linked loans. I'll whip through this pretty quick. This is from this year. This is Lundin Mining, a $2.5 billion US credit loan facility. The key takeaways here The interest rate margin that would be charged to the company is adjusted based on the company's performance relative to SPTs, sustainability performance targets. And we're going to talk, you're going to see this thread. Here's Anglo American, $100 million sustainability linked loan. And it's focusing on social development indicators. Gold Fields from just over a year ago, looking at a $1.2 billion US revolving credit facility. And their KPIs here that they're calling them. This is women representation, reuse and recycled water, abatement in scope 1 and 2 CO2 emissions through renewable energy projects. And you can see that Gold Fields has been very active in South Africa and putting in solar plants. So they are being ranked and scored on these. Here is Epiroc. This is from just almost 2 months ago. Epiroc is a big supplier of mobile mining, underground equipment, drills, load, haul, dump machines, trucks. And you can see here, this is a $150 million US facility. They've listed their KPIs. Scope 1 is scope 2 emissions, scope 3 emissions. So this is obviously their focus is on moving away from diesel equipment through their whole supply chain and their product into machines run by renewables. These are target based. There's pain gain associated with your performance. Usually the community components, if any pain is suffered in terms of the interest rate charge, the excess money would be put back into community projects and not just a win for the banks. The targets have to be measurable. They have to be realistic targets. They have to be stretched, and they have to be a challenge to the company. These would be the criteria that the lenders would apply. There's third-party involvement in terms of ensuring that things are quantified, that they're measurable, and that the company is performing as it should. And this is the landscape going forward for access to capital. Now, with this comes other things. This wasn't part of the talk back at the Kimberlite conference, but there's new legislation that was enacted late in June of this year in Canada, and in cooperation and in sync with the European Union. These are anti-greenwashing regulations. So, and these are real. There's real and substantive penalties to companies if they fall outside of this. So basically, these are measuring the environmental impacts or performance of a company's product, how the company says it's performing. Any claim that is made by a company around their product, their performance, or otherwise has to be substantiated, clear and accurate, based on scientific evidence, third-party accredited, and consistent with, in this case, EU labeling regulations. And ultimately, we can go through increased consumer trust, supporting the green transition, standardizing claims. So this is all to allow the consumer or the investor to have a consistent and fair evaluation of companies' products and the services provided by companies. And like I said, if a company is making statements that they cannot substantiate in quantifiable ways, there are real and substantive penalties that will be applied against them. So in the backdrop, or to support the ESG component, there is this component of greenwashing that exists, but now there exists regulatory and basically legislation to ensure that the companies are reporting fairly and honestly. So I think this is a very, very different topic for the Kimberlite cluster to consider, I think. But this is the landscape out there. So, in order to ensure a continued supply of research materials to universities and to academics, I mean, the mining industry has to embrace ways to make new discoveries, using old data sets, using new data sets, using new targets that are developed through components like machine learning, using different methodologies, improving your recovery approaches. The ESG aspects are front and present, and I think they're front and present in all aspects of our lives right now. We just sometimes are a little more aware of it than other times. But ultimately, in my view, the exploration and mining communities have been under a great deal of scrutiny over a long number of years, more so than other industries, and are well equipped to address these ESG issues. with established frameworks and track records on reporting. So I think we're in a good place. So I would end there. Some of the people that helped with the talk, and obviously it took material from my time with Lucara. So there we go. Hopefully we didn't go too far over time, Gary.
Thank you, John. Thank you for the discussion for the current technology and the ESG in the diamond mining industry. So before the Q&A, Barbara will play a short video on behalf of Eira, and the video is about the environmental and social responsibility of diamond mining.
Yeah, I think we wanted to wrap up with something a little more positive. I think we talked about some of the challenges, but I think we're also trying to highlight the opportunities. I think that diamonds, global supply of diamonds is on the decline. I think the fundamentals remain strong. So as an industry, if we're responsive to kind of the challenges and needs going forward, we've got a very big opportunity in front of us. And I think this video that Barbara's going to play, this was put together by the Natural Diamond Council. They represent about 70 to 80% of global diamond producers. And they are really making a big effort to start improving upon, the marketing of natural diamonds to differentiate them from synthetic, and really talk about the great things that we're doing as an industry to represent, all aspects of the pipeline, but particularly the work that we're doing on the mining side. And Barbara, the video that you've got there is just a short 1-minute intro. But I encourage everyone to go on to the website, which is called Only Natural Diamonds. And you can see a full-length video. And this is from a trip that the Natural Diamond Council did to the Northwest Territories with our ambassador for the Natural Diamond Council, a well-known actress, Lily James. And you can see the full video there. And I think it does a great job of highlighting the positive impact that diamond mining has had on northern communities. So I'll leave it there. Thank you.
Yeah, in the wonder of Canada's Northwest Territories, nature unveils its most exquisite and rare treasure to those who seek it out. This beauty demands our responsibility to protect wildlife, to preserve the land, and to empower the cultures that have stewarded this magic for millennia. 3 billion years ago, elements of stars combined to form natural diamonds so pure and so real that to hold one is to touch the essence of time. Natural diamonds are real, rare, responsible.
So do check out the longer video on Only Natural Diamond, as Ira mentioned, if you're interested to know more on that regard. So now we have the Q&A section, and as we overran a little bit, so I'll try to keep it 10 to 15 minutes, or you can stay behind for a chat after that. Feel free to turn on your microphone or ask a question in the chat box. Right. It usually take a while for the first question, so maybe I'll start with the first question for Ira. So you mentioned about for transparency in the diamond supply chain. So how do we ensure there's a transparency? For example, if we're talking about are the commodity, but you mentioned diamond is not a commodity. Like if we're talking about gold, there's usually like a standard price that the industry are going for. But considering diamond as a different product, and it is different from just evaluating the amount of gold, or we have to evaluate the grades of the diamond, and how do we put a standard on that?
Yeah, well, that's a tricky question, Gary. I mean, diamonds, as I mentioned, are extremely heterogeneous. So there is no standardization necessarily on the price, but it is, of course, based on what is commonly referred to as the 4 C's in the industry, which really relate to, the quality and the cut and the weight of the stones and the color, which sort of define the different categories in a broad-based way. But again, I think that is kind of an outdated kind of terminology, and I think as we go forward, it will be less and less about that and more about the development of relationships between consumers and brands and relationships with the product itself and from where that product is from. So when we talk about transparency today, it's really about understanding where your diamond comes from and being confident that it does actually come from there. So it's about using technology to track a diamond through its life cycle. And that up until very recently hasn't been a big focus for the industry. And it has been a, technologically challenging thing to do. But we are at a point where we can trace diamonds much more effectively. Certainly for large stones, it's not a problem at all. But the technology is now improving even for very small diamonds. And this is something that should help bring consumer confidence around the industry and really ensuring that if you buy a diamond from Canada, you can be confident that it is actually from Canada.
Thank you.
Ira, presumably the traceability will identify diamonds coming from particular mines yeah.
Yes, absolutely. It can get as granular as you wish. And Barbara and many people on this call will be aware that, for many years, we've had the Kimberley process. So it's a process of paper certification, tracking diamonds around the world. But of course, it's not as robust as it could be. And what we're trying to do now is tag each diamond at its point source of origin. So it could be that a consumer doesn't really care if it came from a Caddy or Gachakwe, but they do want to know it comes from Canada. But we can get as granular as we like on the provenance and the traceability, depending on what the consumer is looking for. What we're finding equally interesting now is that consumers really like the story behind the diamond. So having as much detail as possible has actually been helpful. I want a diamond that was mined on February 23rd, which is the anniversary, my 10-year anniversary. And technology, has the ability to deliver that as well. So the storytelling is becoming quite valuable, and the brands have long recognized that. But even the smaller jewelry houses are moving in that direction.
A quick question, probably following the first question. Hi, Ira, and hi,
Hi.
John. Absolutely fantastic presentation.
Nice to see you.
The statement that diamond it's not a commodity, but just like coming into a luxury kind of goods niche. I kind of, again, it's probably my sense. It's almost like we feel about shrinking diamond market or market in a sense that the capital to invest in a new project will be difficult to convince that it's not a commodity, but you can still invest, you can do it. I'm just thinking, again, it's just my perception, because like I can see we're working now in different commodities, and if it's commodity, it's much easier to talk to investors. When it's like we're talking about luxurious goods, it's a bit more specific and more narrow, more difficult, I would say.
Yeah, that's a very good observation. I mean, it is different, and the targeted investors are different.
Yeah.
But I think what certainly I've realized over the last 5 years, particularly post-COVID, is that consumers don't have confidence in prices. We've seen so much volatility in diamond prices. Someone would say, well, why is this a good investment? It could be worth 30% less next year. And so what we need to do within the value chain is stabilize prices. And if we can stabilize it, as we go into this supply decline and it becomes more and more pronounced, then we really are going to see diamond prices start to move up. They should be moving up in this price environment, and they're not. And it's because consumer confidence is low. So when we talk about building consumer confidence, but it's more about the demand side of it rather than, yes, raising capital. We're probably not going to be raising capital from a traditional mining investor. We're going to be looking to raise capital in different arenas, but the bottom line is we need to be a better bet. The banks have stopped lending because, quite frankly, they haven't been making money.
Yeah.
And it's risky because they're not confident that we can sell our product for a profit. So we need to bring assurances to the banks. We need to bring assurances to the consumers. And at the end of the day, that in turn, I think will bring more confidence to the investors that feel that this industry is a decent bet, right? It just hasn't been a good bet over the last 10 years.
Thank you.
So there's a question in the chat box from Tom McCandless. So he asked, could the deficiency in natural diamond production be replaced by laboratory-grown diamond production?
Yeah, it's a great question, Tom. And we could debate this all day long. I don't think so. My personal view is that it's been a race to the bottom on the lab grown side. The technology is getting cheaper and cheaper and cheaper. And if you bought a 1 carat lab grown, 1 carat deflawless lab grown 5 years ago, you would have paid around $4,500 Canadian, 3,000 US. And today you can buy that same stone for $250. So, they're not a store of value. I think people will always, I think they're different markets. I think people buy lab grown to go on vacation with or for fun, but they're not a store of value. And I think when you think about why you purchase a natural diamond, it's for very different reason. You're purchasing these diamonds to celebrate a very important commemorative moment in your life. And whereas lab grown, you buy them because they're cheap. So you buy them for very different reasons. So I don't think lab grown will ever replace natural when it comes to, those major gifting moments. On the small side, absolutely. On the small stones, and when you think about small stones, even for watches, that's entirely possible. But I think as we get into, the larger size categories and even engagement rings, there's been a lot of concern that lab grown is going to take over on the engagement side. They have grown their market share, but it hasn't been, I think, to the detriment of natural. They're growing their market share, and we have to do a much better job of promoting the natural diamond side of the story.
So I have another question for John. So apparently the mega diamond recovery circuit is very important in Peru and making a few large discovery. I just wonder what are the challenges of developing the MDR, and at which point do the mine would need the MDR? Like, how do you make the decision for those technology?
It's a good question, Gary. So I think the time that we knew that we were obviously had much larger stones than was anticipated, even when we did the study work for the phase 2 upgrade. That would be in 2014, about 10 years ago. It was when we recovered the Lesedi La Rona and realized that our selection of top size in the circuit was probably a little too conservative. Although when we built it to that, we were called crazy and called all sorts of different names. But it became evident that the size distribution at Karowe had the potential to yield some very large stones, and it was no longer a matter of debate or questioning, the model, because we had the product on the table that the model predicted should be there, and they were very large diamonds and very high value diamonds. And then it became, a thought process to decide where best we should put an XRT in the circuit. And we all understand that diamonds get liberated very quickly in the process, and the selection of the location after the primary crusher, because we do have to crush the ore, but before the mill, because Karowe uses autogenous milling, is a little bit of different setup than you see in most mines. That became the opportunity to place the XRT circuit. And there was, we call it the Mega Diamond, or it's called the Mega Diamond Recovery Circuit, but it wasn't about the biggest diamond. It was about value preservation and getting that diamond, if it was liberated anywhere in the process, prior to the mill, that we could capture it. And that became the logical place. And the top size was selected at around, at first, just over 100 millimeters in size. The challenges with the MDR are about material handling. It's a coarse product that's going into those XRT machines. You do get undersized material, oversized material reporting to the XRT, so that's a bit of a challenge. The other challenge was about managing people's expectations. So that XRT circuit ran, I forget it was like almost a year and a half, well over a year and a half before I recovered a diamond. And the first diamond to come out was that 278 carat diamond, and it was ugly as sin, right? So, and then that machine ran for another extended period of time until 2020, when the Sethunya was recovered with a 549 carat, probably one of the most remarkable diamonds to be recovered at Karowe to date, and one of the most remarkable diamonds recovered of all time. Spectacular diamond was recovered in the MDR. And then again, it ran for an extended period of time before it recovered the next set of diamonds. So it's about, managing the expectations around, when you're going to produce a large diamond. I think that Karowe has an established track record of producing them. The resource is quite capable of, now we know, producing very large diamonds in excess or pushing 2,500 carats in size. But it's one of the challenges, and we weren't really ever really challenged too much. I think people kind of forgot the MDR was there running, but it's from an operational point of view, it's the getting the mindset of the operation itself to say, look, this machine is going to run. You have to maintain it. You have to treat it like a baby, and it's going to run for over a year and a half, and then something will happen, right? Like but it will happen. So it's around managing that expectation is probably in the whole circuit, even in the LDR circuit. Initially, you've been running for a few months, and there was, we were doing some upgrades on the other machines, and it was, why are we even running the LDR? Hasn't recovered a diamond, that type of discussion. Then boom, in 48 hours, it produced $120 million worth of rough. So it's managing that expectation, especially with a resource like Karowe. So I think I kind of answered the question there, Gary.
Thank you.
Quick question to John, my last question. New technologies, and you, John, covered it very nicely, Renard with near-infrared and color, sensor machines help a lot. But XRT obviously was much earlier. I think it's about 2015 or 14, you committed for that. Would it be fair to say now with artificial intelligence, quantum computers, we can bring new technologies, new basic computer-based technology much faster into use in diamond mining or generally into mining exploration?
Yeah, I think, well, thanks for the question, Vlad. Good to see you. I think there's an opportunity, I touched on it, and you see it referred to around diamond damage, diamond breakage. It really, in my opinion, we've had lots of discussions. We can see that, and at times I've been told that we do a very good job of breaking diamonds, which is true, but it is a bit of the nature of the beast. And I think previously you were chasing a ghost, in a sense, in my opinion, of where the damage was occurring. Part of the work that was being done at Karowe feeds into that AI, feeds into machine learning around diamond damage. And I think that's a value proposition there that could be exploited on the processing side, right? And then, obviously we've seen that that some of the new technologies being applied to these large data sets generating targets in very, very mature environments and going and having success shows everybody that there should be an investment in that technology.
All right. Because time is running out, but there's still a last question to Eira. So it's quite a long question. You can open the chat box and I'm going to read it out. So as a question from Aidan, do you expect there to be challenge in marketing a luxury product to the upcoming generation who have thus far more or less taken on the idea of sustainability and minimalist lifestyle? Would this encourage an alternative marketing tactic towards industry, towards inclusion, rich diamonds?
That's a great question. It's interesting, and De Beers has done a lot of work in trying to understand kind of the demand coming from younger generations. And although there seemed to be this big push towards lab grown as being more sustainable, I think the NDC, the Natural Diamond Council, has done a good job of kind of pushing back on that narrative, because we can demonstrate that there's a huge amount of value from natural diamond mining that doesn't come from lab grown. And what I mean by that is there are huge social benefits, obviously economic development in countries like Botswana, which it's a very, very important value driver. This is an industry that has been environmentally responsible. It employs a lot of people, but also what's interesting is that our carbon footprint is actually lower than lab grown. A lab grown diamond consumes as much as 3 times as much carbon as a naturally mined diamond. So I think part of it is about getting the real messages out there and the real facts out there. And then the second piece, I think, is as an industry, we've done a very poor job of actually investing in marketing. And this is something that, De Beers last week at the Facets Diamond Conference really called us out on. And I think they're absolutely right. As an industry, we should be investing more, and we're going to need to invest more if we are going to really prevail in kind of the battle against lab grown. I think we absolutely can, but it does require investment. So I don't know if I answered that entirely, but I think that, the bottom line is we see strong demand coming from younger generations, and we just need to continue to do a good job telling our story and continue to make sure that they are armed with the facts.
And I think, Ira, to answer the second part of the question in a way around the use of less than gem diamonds in
Sorry, I
jewelry
forgot
type
that.
things. I think that exists as a very small niche, and I think it probably could be built out. There's some kind of cool things that can be done with diamonds. I showed the image of the dice. Those are natural diamonds. Those are natural inclusions in the diamond that were cut into that die there. So, but the inclusions themselves were natural. There's lots of opportunities. I think even moving beyond set jewelry into textiles and the combination of textiles and diamonds and things like that. Instead of having, rhinestones, you can have, less than, non-gem diamonds as your rhinestones. I think there's lots of opportunity there. It'd be pretty nichey to begin with, but there you can probably make a really healthy premium on some product that's hard to move, right? By creating those niche markets. So I think it's definitely something that someone will probably embrace, and it's already happening, but on a bigger scale.
Thanks, John.
Okay, so this is the end of today's session. Thank you, Eira and John, again for the presentation, and thank you everyone for attending. You're welcome to stay behind for a chat after the recording is off. Thank you.
Thanks, everybody.
Thanks, everyone.
Thank you.